Aditya Narain of Edelweiss Securities is now joining us live with his views on how all of you can beat the street. Good morning. Welcome to the show. I'll begin with the big news that came out on Sunday. The stock is on fire. We saw the exhibition stocks on fire on Friday as well. What did you make of the PVR-Inox deal? What is it going to do for the sector at large?
Well, it's a super transaction as far as shareholders of both companies are concerned. I think quite clearly you have seen an up move, which is part adjustment, part excitement. You probably will see an up move in terms of multiples from a more medium-term perspective, simply because this entity does get a lot of pricing power. But I think what is interesting is that it is what one would perceive relatively early in this growth cycle of this business that you're having the leaders consolidate. So I think this has wider ramifications in terms of whether you're going to be shifting to profitability much earlier than what one would have expected. But I think that's the interesting takeaway. It's an unexpected merger simply because there seemed to be such a long pathway to growth. And both the leaders have decided to consolidate and try and make it more profitable.
Okay. The stocks are very much, of course, in focus. The last time we had you on the channel, you gave us two ideas to beat the volatility and to make volatility an investor's best friend. That was banking and IT. Is that how you're still writing it out?
Very much so, very much so. I think, if you step back, I would tend to believe there's been a lot of focus in terms of margins and the risk to margins given the broader environment. I think that is true, but most people have their eyes on this element. But I think the bigger risk, or the more unappreciated risk in this environment, really is demand, which is going to get hit because of these price hikes that you're seeing, because of the inflationary environment. And given that, we would rather be in sectors where demand risks are relatively lower also. IT clearly stands out. We think demand risk is minimal there. And as far as banks are concerned, I wouldn't say there aren't risks, but I think there isn't too much being built into growth expectations as far as banks are concerned. So I think we're somewhat protected there. So I think if we step back, I think these are trades these are sectors that we continue to be comfortable with, given the solidity of the underlyings and the limited risk to the top line.
Aditya, just wanted to understand, what is it that you make of, the news flow out of China, the fact that almost half of the country is now under lockdown owing to the Omicron wave, and it's bearing then on metals, because I'm guessing it's bound to get a whole lot volatile, at least in the near term.
So I think there are a couple of elements to look at. One is the fact that as far as market reaction to the way COVID has been looked at in China, I think global markets have run very independently. They've run more with COVID cycles in the West and in countries like India, and have kind of been away from the lockdowns in China or the responses in China, simply because there hasn't been enough belief there. So I think at one level, I think the market's reaction or the market's perceived risk to what's happening in China, I think will tend to be relatively limited, because it's been out of the market equation for the last 2 years in some senses. So I think that's one element. I think the second bit, where you specifically picked up the issue of commodities and whether there's a certain amount of risk there, I think there are two ways of looking at it. One, at some level, commodities have got valued up. They are going to be more important in the scheme of things, whether it's the softer ones or the harder ones, simply because you have seen war disruption that are not likely to go away very quickly. So I think at that level, commodities are going to be more important and therefore valued a little better. But I think the second bit is on whether that has already played through as far as stock prices is concerned. And I think if you look at the last quarter or so, YTD, commodities have done pretty well. Their earnings expectations have actually gone up relative to the rest of the market. And so to that extent, I think the stock upside, has tended to get a little limited. So bottom line, I think there will be volatility as far as the metals and the commodity space is concerned. But I would also tend to believe that the best in terms of stock prices is really done. So you would be sitting on probably more downside risk than upside risk there.
Aditya, it's quite interesting to see that you're a contrarian when it comes to FMCG. Just when company after company is coming out and saying that they are going to be under significant pressure owing to the raw material costs and that there is going to be margin compression, I understand that you actually like this sector. Why is that?
So one, you're absolutely right. We like the sector. We've stuck our necks out on it, and we've done it after a fairly long period of time. So our argument is actually very simple. As we said, the margin risk that people are talking about, I think that is well flagged. You are going to see the implications of that in terms of numbers, but nobody's going to be surprised with it. I think where the risks are not fully appreciated is in terms of the demand side, where at the end of the day, the FMCG side will be a little bit more robust or will have a little bit more downside protection simply because it's more stable in nature. Whereas a lot of the rest of the market could actually see much, much more risk in terms of the demand side. So bottom line is, we'd be careful in the market, as we mentioned previously. You've got to look at the downside, but what is not appreciated on the downside is demand risks. And that's where FMCGs come in well as a defensive. I think you will see poor numbers. You will see a fair amount of head scratching on the back of that. But from a stock perspective, you'll probably get better relative performance there than you will with a lot of other sectors in the market.
What's the sense that you're getting when it comes to, the digital and startup ecosystem? Because there is a lot of money to be made here, but equal amount of risk appetite that one needs. Basis the way some of these companies have fared post a very memorable listing, it can't go down well with retail investors. What's your advice?
Yeah, so I think, with them, you've had money made and you've had money lost. So I think that's the point in time when people start thinking harder about these. I'd say there are 2 or 3 things to look at, from an investing perspective. The first is that these will fundamentally be volatile. It's not going to be a one-way street simply because the valuations capture so much growth and so much long-term growth that any changes in expectations there will have a disproportionate impact on stocks. So I think that volatility element will tend to be high. I think the second bit, which was underappreciated when these stocks came to the market, is the fact that at many levels, there's been a huge linkage with the monetary and the rate environment globally. The easier it's been, the easier has been the outlook, the greater has been the valuation pump up that has happened here. Ever since that has reversed, right, the risks have tended to play through in terms of stock prices. And I think that is an ongoing risk that sustains. At the end of the day, as far as the US is concerned, there's no talk about them coming back from the rate hike expectations that they have and the contraction in balance sheets that they are planning. And so to that extent, from a stock valuation perspective, a lot of the froth has come out, but some of those risks tend to remain. So bottom line is, I think at this point in time, I think, as I said, the obvious froth is off, but they will still tend to be volatile. And I think retail investors or others who are looking at playing this space should have the stomach to take a reasonable amount of volatility there.
And how do you explain the kind of relentless FII selling that we witnessed of late? And do you see the tide turning anytime soon? Will it be a case of, DIIs sort of continuing to pour in money?
So I think the easier answer is probably that DIIs will continue to pour in a reasonable amount of money with a reasonable amount of consistency. And that's important. The consistency element is very, very important. And that's being borne out in the SIP flows that you are seeing. I think the question in terms of foreigners selling, it's typically hard to call. But I think one of the elements one needs to take a close look at is the fact that this entire emerging market basket, as it were, or this pool of assets, I think that's under a little bit more threat than is commonly perceived. You have a situation where China, which has been dominant, for some is now uninvestable, or they'll think really hard about investing there. Russia, which was effectively a big name, is out of the equation now. And Brazil stays predominantly a commodity play. So what tends to happen is that the bulk of the money that we've historically got in and out has tended to be EM money, right? And if you have that whole EM class under a lot more consideration now, it's going to be a challenge for India to continue to get money or, continue to be very favored simply because, the whole pool of money is tending to flow out. So I think that becomes a little bit of a risk. And I think that's what one needs to watch for. How does one so-called counter it, or how is there an offset that happens with India then tending to stand out if you look beyond the regular markets? I think what you end up requiring is India-focused funds. Now, we've not seen too much of that happening, and inevitably that takes a fair amount of time to build up, and fair amount of individual country pull, rather than better than stuff that's not good. So that will take time. So again, to put it simplistically, I think we're part of the EM pool. The EM pool is struggling. As long as that continues, I think the risks will tend to be high. But within that pool, India is standing out. Will that necessarily bring in hard money or quick money? Difficult to call.
Aditya, how closely are you tracking the bond market and what we have been seeing since, a couple of sessions now, but all of that getting aggravated last week. BOJ has now stepped in when it comes to Japan. Look what's happening in Korea too.
Yeah, so it's not as if we track it upfront, but I think the reality is the risks are that rates will tend to rise globally. The US has been very firm-footed about it, even in the face of this war that they're actually seeing at this point in time. And quite honestly, at some point in time or the other, the rest will tend to follow through. India has tended to be a fairly decisive standout so far, both in action and in terms of commentary. So to some extent, we might hold out a little bit longer. But the reality is, if the wind is blowing in a particular way and is blowing very aggressively, at some point in time, India will have to follow through, and the markets will probably start reflecting that before the policymakers do. So yes, I think that risk will sustain. It is a little bit of an overhang on the market, and particularly so because the growth outlook per se itself is a little challengeable. You see, I think one of the things that you've really got to look at closely at this point in time is that US is becoming a little bit of an isolated economy at this point in time. They have inflation like everybody else in the world, but they actually have very strong growth. The rest of the world is stuck with inflation, but they don't have equally strong growth. And so they tend to be a little bit more vulnerable. And India is part of that pool, I think.
Your year-end target for the Nifty is 18,000. I know Aisha asked you this question the last time you were on the channel. I'm going to ask it this time. You still sticking to it?
Yep. I think we were at 18,000 when the market was at 18,000. So no reason for us to pull back at this point in time. But yes, I think, in terms of the risks at this point in time, they are very demand-centric. They are probably a little bit more than what is fully appreciated at this point in time. So the year is going to be generally a slightly up and down year, but generally a tough year also.
Okay. And Aditya, sectorally, what do you think is going to take us closer to that target?
Well, I think just reiterating what we said earlier, I think we are comfortable with IT and banks for absolute return, right? We get a little bit of cushion from the consumer staples place just to be defensive in the face of any cracks that might come through. And we think there might be a little bit of life as far as the auto space is concerned, because even though they face demand risks, a lot of that has been flagged, and to some extent, there's a little bit of support in terms of valuations. So that's how we would tend to position our broader portfolio to get, at the end of the day, fairly nominal returns from here, 6-7% by the end of the year.
Sure. Okay, great to have you on the show and good speaking with you as always.
Thanks. Have a good day.